Hello, everyone. Welcome to Wall Street from Main Street podcast. My name is Mo Daoud, alongside John Manfreda and Jason Burek. And today we're going to talk about the U.S. dollar index and the difference between that and the trade-weighted index. And also we're going to talk about the Fed exit plan or lack of an exit plan. Fellas, how you doing today?
Doing pretty good.
I'm doing well, Mo. How about you?
I'm doing well.
Are your brackets busted?
No, it's still there. I haven't lost. The teams in my Final Four are still alive, so that's good.
I filled out a bunch of brackets, and some of them are absolutely destroyed.
Oh yeah.
Yeah.
Did you have Georgetown in the Final Four?
On one or two brackets, yeah.
Oh, okay.
But not on all of them or anything.
I just filled out I didn't follow it that much this year, so I just filled out who I wanted to win.
Yeah, neither did I. I don't follow college basketball nearly enough. We're too busy following the markets, and then I have time for baseball and football, and that's about it.
Yeah. A lot of teams in college basketball. Hard to figure out who's good and who's not good.
Yeah, there's just too many games. I mean, I like the NBA, but it's less games. I just don't have as much time because I spend so much time on the markets, like you guys.
Yep.
Okay, well, as much as our listeners probably like sports, let's get on to the real meat of the podcast here. Important thing here that we wanted for our listeners is that the dollar index, which is basically weighing the dollar against the G7, the dollar index is only weighing the dollar against 6 other currencies. So the euro, the yen, the British pound, the Canadian dollar, and there's a couple other.
The Swiss franc and the Swedish krona.
Swiss franc and Swedish krona. Thanks for that, Mo. Yeah, so that's obviously not a very accurate measure then of how the dollar is doing against the rest of the world currencies, obviously, because there's a lot more currencies than just 6. So this is something we want our listeners to really understand here. I wrote an article on my blog website a couple years ago called Problems with the Dollar Index and Why It's Misleading. And there was a prominent investor by the name of Louis Novalier. He is a very good investor, has a lot of expensive pay newsletters. And his quote is, if you only watch the dollar index, there is no way you can know how sick the dollar really is. And I think this is a very accurate quote because the dollar has actually been strengthening on the dollar index. It's been looking good. But if you look at the trade-weighted index, guys, it's a completely different story.
Yeah, because if you look at how the U.S. dollar index is calculated, it's measured against the British pound, Japanese yen, the Swiss franc, which is pegged to the dollar.
Swiss franc,
and the
euro, yeah.
The euro. And we have the euro. And about almost all of these countries are involved in the currency war, so everybody's trying to devalue their own currency. And
prop up the dollar. Devalue their currency against the dollar. I think that's the important thing. Yeah, right?
Yeah, against the dollar. And so they're winning the race against the dollar. So that's why you're seeing a rise in the dollar. And I think we talked about this in our last podcast last week, which is one of the reasons why the U.S. dollar is doing very well is because the other central banks are printing money as well, and they're trying to devalue their currency against the dollar.
And what are they buying, Mo, when they print up their own currencies? And this is why they're propping up the dollar.
They're buying the dollar, the Treasury bond.
Exactly. Okay, so I think we covered that and why the dollar index is misleading. So let's talk about the other index and what it's telling us that's different than the dollar index. Read a definition. One of you guys read a definition then of the trade-weighted dollar index for our listeners who are not familiar with it.
That is, the trade-weighted index is the dollar up against 26 different currencies. And it has heavily weighted China is the second heaviest weight. It's in individual country, it's the heaviest weight. The Eurozone is the heaviest weight, Canada, and it has 90% of our trade partners. So it's more measured against our trade partners, not just the bearish index. And I'm looking at a chart, and it depends on where it goes. It's depreciated a lot more than the U.S. dollar index, but if you look at it from the middle of 2011 on, the dollar has risen against it, but it hasn't risen as much as it has in the dollar index measured against the 6 currencies. So it's not in the short term appreciating as much as it is against like the euro and the Swiss franc and the six indexes. So, and the trade weighted index even has stuff like Singapore, Korea. It has Hong Kong. It even has Saudi Arabia, Venezuela. All our oil countries that we trade with. So it has a lot more. It's a lot more accurate because it's a lot better measure of our imports exports.
Yeah, and we'll attach a link for our listeners in the text box for this podcast, but there's a really good chart on the St. Louis Fed website. And from 2002 onwards, guys, there's just a humongous downtrend in the trade-weighted dollar index. It reached a peak high after starting off very low. It reached a peak high of around 130 on the trade-weighted dollar index, and since then, basically, you can draw a trend line, a descending trend line down a lot. I mean, there was a big spike around 2009, it looks like, which is, I guess, because all the money went into the safe haven when after the markets collapsed in 2008, and I guess a lot of safe flight capital and hot money went into the dollar then. But the trend is clearly down. The trade-weighted dollar index since 2002 up until now, it has gone from 130 down to barely 100, and it's barely holding support down there. So I'm thinking it's probably going to go even lower than that. I mean, the only thing that's really keeping the dollar up is, Triffin's dilemma and some of the other things that are involved in world trade, and like Mo mentioned, currency wars, and how other countries want to stay pegged to the dollar. They want to prop up the dollar to a certain extent. Why did they do this? Because they want the U.S. consumer to not lose all of their purchasing power, so the U.S. consumer will keep on spending and buying the exported goods from these developing countries. And this is what a lot of listeners out there do not understand, is that, everyone's predicting, well, not everyone, but a lot of Austrian school economists are predicting a dollar collapse, and this is why we haven't got it, is because we have these other countries and their central banks and their politicians in the currency markets, in the U.S. Treasury market, printing up their own currency, and then buying U.S. dollars or Treasury bonds.
And most recently, that's Japan, who's been doing a lot of it, and the Eurozone. Bloomberg had a good article about the European Central Bank doing currency swaps. And that has really artificially propped it up in February. So there's a lot amount of currency swaps that have been doing it, too.
And England, too, guys. I mean, England, on our last podcast, we talked about how Japan and England were winning the currency wars. And, I mean, I think England's been rapidly devaluing the pound against the euro and also against the dollar.
And yeah, Japan has been printing, going to print $135 billion per month, which is much more than what the Federal Reserve is going to do. So what the Federal Reserve is going to do in reaction to the Bank of Japan, they're going to have to print even more, and just to get the dollar to go down.
Yeah, so we're in the stages of currency wars here. It's just a humongous amount of fluctuation. I've seen a lot on CNBC how the short yen, long U.S. dollar trade is over. It's not dead, guys. It's just taking a break, in my opinion. It was an overcrowded trade, but the fundamentals are very clear. Japan has the most. Japan and the UK, in my opinion, have the most near-term problems. Maybe Europe is going to have some problems now with some potential bank runs if contagion spreads after the Cyprus stuff. That's something we could talk about if you guys want to. But you don't know what the stuff that's going on in Cyprus, because obviously there's a lot of money in their banking system. Even though it's a tiny country, there was a lot of money parked there because it was considered a banking safe haven and flight capital and stuff.
Yeah. Well, another thing is also with the yen. The one reason it also took a break is a lot of currency traders such as George Soros took profits. And so when they take profits, yen gets a small little boost for a couple of days. So I think it will continue to devalue, though.
Yeah, I think so too.
So looking at we discussed the difference between the dollar index and the trade-weighted U.S. dollar index. So how Main Street investors, why should they be concerned between those two differences when they invest?
Well, for a lot of multinational corporations, a lot of these guys are aware of these fluctuations, Mo. So some of these larger corporations, if they're really good, they're going to start hedging their risk in the currency markets. So like a Walmart or a Ford or some of these other companies that do, or Johnson & Johnson, they do business in over 200 countries all over the globe. They obviously have some foreign currency hedges, right? So that, or Philip Morris, they sell tobacco in over 100 countries. So they're going to be hedging their currencies. Those type of companies I mean, the people in the companies are going to handle it. You know what I'm saying? But for our listeners out there, I mean, if they want to do currency trade, that's a whole nother education, a whole nother ballgame. We outlined this in the last podcast. There's a lot of risks and dangers with currency trading because a lot of brokers will try to give you too much leverage, and you don't have the experience and you don't know what you're doing, and you can hang yourself with a lot of rope. So I think our listeners in general, I think they just need to understand that everyone's trying to devalue. And everyone can't do it all at once unless they all start devaluing against gold. But we're not at that desperation stage yet where the central banks, like in 1933 with FDR and the dollar, could not get any inflation going. So as a desperation move, FDR to confiscate gold and then devalue the dollar against gold. We're not quite at that stage, although we are seeing, guys, central banks start to stockpile gold. So they're printing more money, like countries that are running trade surpluses, like China and Russia and Korea. They're printing a lot more money, too, to counter the printing from other countries, and then with their trade surplus money, they are buying hard assets like physical gold.
And not only that, the countries like Saudi Arabia, they're buying gold too.
Yeah.
Huge amounts.
Yep, and Turkey as well. And so I was looking up the percentage of the currencies of the emerging countries and compared it to the U.S. dollar. Look at a country like Brazil. The U.S. dollar depreciated about 7% since the summer of 2012 against the Brazilian real. If you look at the Australian dollar, depreciated 8% against the Australian dollar. And if you look at the Russian currency, depreciated 8% as well. So if you look at the emerging the countries and the currencies, some of them are appreciating against the U.S. dollar.
Yeah, and they don't want that. And you've heard the head of the Brazilian central bank. He was the first one, I believe, besides Jim Rickards, to start talking about currency wars in public. And the politicians don't want to talk about currency wars now. They don't want to. Obviously, since they say they don't want to talk about it, they're actually doing it. But to add to Mo's point there about developing countries, I think the Philippine peso over the last 5 or 6 years has appreciated 30% against the U.S. dollar. So that's a massive move in favor of purchasing power for the Philippines over there against the U.S. dollar. And, there's other similar stories, too. You have, like, Thailand, how the Thai baht has gained a lot against the dollar. Singapore has gained a lot against the dollar. And these countries, had a lot of problems decades ago. They had, you had the Asian tiger crisis in the 90s where these governments went bankrupt, and I guess they're learning from their mistakes. They're running trade surpluses. They're not running humongous government budget deficits. They're being very efficient. And the developed world, guys, has turned, Japan, the UK, the US, Europe. They've turned basically into third world countries. They're acting like third world countries. They're acting like basket cases.
Well, our neighbor to the north, Canada, over the past 10 years, they've really appreciated against the dollar. Big time. It used to be in the 90s, $1 used to buy 2 Canadian dollars. And now 1 Canadian dollar is worth more than 1 US dollar. So
yeah, that's pretty crazy.
Canada, the commodity currencies are doing well. Australia, Canada, they've over the past 10 years, they've really appreciated against the dollar. And I think that's a trend that will continue. Maybe not in the short, but over the long term, it's definitely going to continue.
Okay, so let's wrap this up then for our listeners. And the dollar index looks very strong. It's in a trading range, especially the 5-year chart on the regular dollar index. It's stuck between 84 as a high, 83 and 84 as a high resistance level, and around just above 78. It's in a tough trading range there, and that's probably because of central bank intervention from other countries, right, in the G6 and G7, right, who are buying up dollars and treasuries, right, to make sure the dollar doesn't collapse, to prop it up. So consumers in the U.S. will continue to spend. and those other countries can run trade deficits, and those politicians in those other countries can stay in office then. Is that a good wrap-up there of the regular dollar index?
Yes.
Yeah.
Okay, and the trade-weighted dollar index is telling a much different story than the U.S. dollar index, and it's saying that the U.S. dollar is losing its purchasing power much more rapidly against other developing countries like the Asian countries outside of Japan, and et cetera, et cetera.
Yes. So
Over the long
that's
term, yes. I would say over the past year and a half, it's somewhat similar, but that's because of the safe haven status.
Yeah, and there's so much hot money, guys, like the high-frequency trading programs, the momentum traders, the trend traders, all these hedge funds that are managing billions of dollars that can move money literally out of the bond market into the stock market, into commodities in one day or less.
Yeah, they can move it so quick, too.
Yeah,
in the 90s, it used to be more of a gradual move. But now, the old advantage was that small investors could beat large investors because they can move their money around faster. That's no longer the case.
Well, I think small investors can still win if they do swing trades, longer trades where they research fundamentals and they mix in technicals and value-based investing.
I just meant following the.
Oh, okay. Oh yeah. Trying to day trade though and trend trade against the computers and machines is I don't think it's a winning game.
Yeah. Oh, I just meant following where the insiders are moving their money. They can move it so much faster now. I think that type of trend trading investing just doesn't work anymore.
Well, it doesn't work for the little guy at least.
Yeah, it used to be able to work because moving money around was took so much longer to do. But now they can move it so fast. The insiders can be in and out and before you can even look it up.
Okay, so we're going to post some of those links that we talked about the dollar index and the trade-weighted dollar index. We'll put those in the text box. And for listeners having more questions, please email John Moe or myself at wallstreetformainstreet@gmail.com, and we'll answer your questions about that. So let's move on, guys, to the other thing. And, we hear this all the time now on CNBC and Bloomberg and Yahoo Finance and everywhere else from the mainstream. And they just parrot everything the politicians and the central banks and stuff say. They don't even question them on it, really. And it's that the Fed has an exit strategy. So, first of all, we'll state our argument whether or not we think they have an exit strategy. But let's talk about the Fed's mandates first. Okay, so the Fed's mandates, and this is what Congress amended the Federal Reserve's mandates to, is they're supposed to effectively promote the goals of maximum employment, stable prices, and moderate long-term interest rates. Is the Fed doing any of that, guys?
No, they're not. If you look at the real unemployment, it's around 22-23%. So it's pretty obvious that they failed in trying to create jobs for the U.S. economy.
Yeah, exactly. And there's a lot of underemployed. There's people that are working part-time jobs that are overqualified, that have, 2 degrees. They have a master's degree in something, and then they're working at McDonald's or they're working at Walmart or they're waiting tables. I know a lot of this is a D.C. metro area. We're in the D.C. metro area for our listeners who are not familiar. And the D.C. metro area has one of the lowest unemployment rates, besides maybe Texas, Oklahoma, North Dakota, the shale oil areas, in the entire country. And yet there are a ton of people here who wait tables and are bartenders who have master's degrees in different subjects. So that's a misallocation then of resources, then I would say. And, people who should be getting paid or doing jobs for other specializations, and just to survive, they're waiting tables and bartending and other things.
And then there's a lot of people who are working, jobs after their full-time job because the cost of living has gone up so much. A lot of people have to work on weekends. They have a full-time career job, and in the 90s they wouldn't have to, but now they have to work, on weekends just to live paycheck to paycheck.
Yep, and there's people sacking their 401ks in Iowa to pay for the bills. There's people coming out of retirement and going back into full-time jobs because they didn't save enough money or too expensive to live. So there's a lot of signals out there that's telling us that the economy is never recovered or not in a recovery mode as of now. And so let's look at the Fed so-called exit plan. If you look at history, the past a couple years since the 2008 financial crisis. And anytime they talk about a Fed exit plan, they actually end up never doing it. What they do instead is roll out another QE program. An example of that would be right before QE2 came out, they talk about having an exit plan, and that never happened. And instead, they rolled out QE2. And a couple months ago, they talked about an exit plan, and now the past month or so, in their FTMC minutes, they talked about there is no exit plan as of now. So if history is any indication, the Fed really don't have an exit plan because they can't really unload all that treasury bond that they bought.
Yeah, I mean the Fed, it's the open mouth committee guys. I mean these guys act like politicians. They want to say one thing and do another. They don't want to scare people. They don't want to tell people the truth. They only want to tell the truth, like politicians, guys, when it's convenient for them. So, and I think Bernanke's, starting to realize that the shit is about to hit the fan, and I think Bernanke's going to get out. I think he's going to leave Fed chairman before everything blows up. I think he'll be out probably in the next 18 months. That's what I've been hearing recently. That
his term is up in January, so I doubt he'll be back.
Okay.
Yeah,
So then he'll definitely be out. So then he'll definitely. So let's talk about then. Okay, we talked about the Fed, why the Fed wants to talk. Okay, the Fed wants to talk things down because the Fed wants to create the inflation. They want to print the money, but they don't want the negative repercussions of commodity prices going higher. So let's talk about then the real reasons for quantitative easing. Why does the Fed do QE? So I will outline 4 reasons, guys, and you guys can talk about them then after I outline them. Okay, reason number 1, Congress. The Fed doing quantitative easing, and I don't even hear smart people who are book smart on CNBC and Bloomberg talking about this. It is done, the main reason is for Congress to be able to run unlimited budget deficits without Congress raising taxes 20 or 30% over the next 6 months on a direct tax. So that's reason number 1. Reason number 2 is to protect and repair the large banks, Wall Street and the large banks. That's the Fed's real mandate, is to protect the banks, not to protect the Main Street USA citizen, is to protect Wall Street and DC and the large banks. So, the Fed, even if the Fed is saying, the economy is looking good and the leading economic indicators are looking good, the banks are still hemorrhaging money, right? I mean, the European banks are still doing really, really bad. I remember Kyle Bass and Eric Sprott saying the European banks are going to collapse any day now. And then all of a sudden you're seeing that the Fed is giving the European banks like $200 billion a month now in a backdoor bailout. So that's reason number 2. Reason number 3 is currency wars. Our listeners know more about that, and you guys can talk more about that in a second. And reason number 4 is the wealth effect. So those are the main reasons that QE, quantitative easing, money printing, whatever you want to call it, gets done.
Well, yeah, definitely. In fact, and it's to control the market. That's why everyone's always listening to see what the Fed's going to do. That's why traders are always doing it. It's basically they've hijacked the market now. I think free market forces will eventually reinstitute itself, but for now, they've hijacked the market, and they're talking about an exit plan. And the Fed, I don't think they're stupid. They know what's going on. They know we don't have a real press, and they know they're not going to get any tough questions. So they can go along with this, and they know if they just say, yeah, we're going to do this, and we're all in, and we're not going to let deflation happen no matter what. They know gold, silver, and oil, the three
main commodities?
Yeah, well, 3 things the Fed doesn't want to see rise would go through the roof. And the U.S. economy would just destroy itself. Last time oil went to 140, we had a massive crash. Of course, that wasn't the sole reason, but, it was a contributing factor. But gold, silver, last thing they want is people talking about gold and silver and a gold standard. So that's why they do this. We have an exit plan. They don't have an exit one, but as long as they can get away with manipulating the market, they're going to talk about it.
And I keep hearing the talking heads, guys, about the Fed needs to let interest rates rise. And this is why the Fed's going to keep doing QE. They don't want interest rates to rise. Because if they know the interest rates rise, right, the Keynesians say that when interest rates rise, that means the economy is healthy. And this is where the Keynesians are wrong. The Austrian school, the free market school of economics, says when interest rates rise, that normally means the economy is doing very, very poorly because the interest rate is a signal for people to not start spending money, not make investments, to start saving their money, hoarding, not taking on debt, not producing more than they consume, saving the difference instead of consuming more than they produce. So, if interest rates rose, guys, the interest payments on the national debt, for our listeners out there, the officially stated national debt, and this is not using generally accepted accounting principles, this is not accounting for off-balance sheet bullshit that the Fed adds, and this is not accounting for the unfunded liabilities, for Medicare, Medicaid, and Social Security and all those other entitlements that we have coming, in addition to Obamacare and all these other Medicare, prescription Part D, et cetera, et cetera. So the officially stated deficit is $16.5 trillion. So for every 1% rise in interest rates, guys, that's over $160 billion in interest payments for every 1%. And
Right.
the U.S.'s tax revenues, right, the U.S. at most is only taking in around $2 trillion a year in tax receipts. So a couple percentage points rise, guys, and there's just not going to be any most of the U.S.'s money then that the government takes in for tax receipts, even if they raise taxes much higher, would have to go for interest payments on the national debt. It wouldn't pay back the principal, and the regular economy, the real economy, Main Street, would be destroyed even further.
And that goes back to reason number one, why they roll out QE. The reason for that is so the government can borrow money at almost 0% interest, so they can so-called stimulate the economy and create jobs. And if you look at what they did in 2012, the U.S. spent around $220 billion in net interest on its debt, and projected to hit $1 trillion a year by 2020, assuming interest rate doesn't go up. So,
the U.S. has become a subprime borrower, right? Because the U.S. is borrowing even more money than it did 6 or 7 years ago, right? And because the Fed has interfered in the bond market with the interest rates, right? The interest rate has dropped. So the U.S.'s interest payments are still the same as they were six or 7 years ago, guys, right? But they're borrowing even more money. And the only reason is because the Fed interfered in the market to lower the interest rate payments.
Yes, yeah. So that covered reason number one. Reason number two, you just said that the reason they do QE is to bail out the banks and to keep them alive. And you're right. Without the QE, these banks would not be in business today. A lot of them are financially in big trouble. They don't have enough capital to keep the business going, and without the bailout, they probably won't be alive today.
Well, the banks are rotting flesh underneath. Their real fundamentals are rotting flesh. But I mean, as long as they don't have to report they can mark their assets to any levels they want. I mean, the bank stocks are gonna go up, right? Because the banks are getting free money, and they can speculate with it. And then if they screw up, they get more money, so they can just write off the losses, and they're going to continually get free money to bet on stocks and other investments with, or invest it outside the United States.
Well, not only that, I looked at some of the bank balance sheets, and the debt-to-asset ratios are, pretty close to 1-to-1. But people have to remember,
and they're not
debt-to-asset ratios are close to 1-to-1. The banks are allowed to evaluate their assets at any. They don't have to value it at the current price or the current market value. They can value it wherever they want, their projected value or whatever. So their debt-to-asset ratio is a lot worse than it says on their balance sheet.
And yet they have record profits because they don't have to mark their assets to a real market, because that would make them insolvent. So, I mean, we're just in a weird market, guys, where the bank stock, the banks are making record profits here and record spreads because they're getting free money, and they're lying about their asset base, and the bank stocks are going to. I cannot suggest anyone to buy and hold bank stocks long term, but if people want to trade them, as a trade, I think they're pretty decent trade.
Porter's recommending them as a trade too, and he's probably right. That's probably what Porter sees, is that they're allowed to lie on their assets, they're getting free money, and they're going to make a quick profit. Eventually, they'll be insolvent, but as a trade, they might do well.
Don't forget the liability that's not in their balance sheet. They have a lot of liability that's not stated in their balance sheet, and God knows how much that
over-the-counter derivative market, right? Yeah, they have humongous exposure.
Yep.
Yeah. I was looking just at the liabilities they claim, and if you look at that, the liabilities they claim are still outnumber their assets. So, and then if you go what Mo just said, it's unbelievable how insolvent these banks are.
Okay, so I think we covered that pretty good, the first two topics. So basically then, the politicians don't want to cut any spending. They're even arguing over decreases in an increased spending rate. Even a little cut in an increased spending rate, the politicians are fighting over. They're saying, military people aren't going to get their weapons, people on welfare aren't going to get any food. They're grandstanding and, saying a lot of crazy stuff that's just not true. And, especially with Keynesian economics, which panders to the politicians, I just don't see the Keynesians wanting to cut spending. You hear Krugman saying we should spend more, can't cut spending, blah, 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 blah. As long as people like that are in the Federal Reserve, who are the main decision makers in the Federal Reserve, Bernanke is, I don't know if he's as bad as Krugman, but, he's very similar ideologically to Krugman, and so is Janet Yellen and the other Charles Evans, some of the other crazy neo-Keynesians and Keynesians in the Fed. I just don't see the government cutting spending, and they're going to want to run budget deficits without massively increasing taxes rapidly on everyone. And the only way to do that is to allow the Federal Reserve to monetize the debt and, keep running budget deficits that way. So, and then you have the other one that we just talked about.
We talked about currency war. We talked about that in a podcast last week, and we talked about it in the first 20 minutes of this podcast. People can refer back to that when we talked about currency war. But the last reason is the wealth effect. Though when we talk about the wealth effect, we're talking about how the Federal Reserve would privatize all the losses for the bank, socialize all the losses for the banks and privatize all the profit that they get from the QE.
And also, Mo, with the wealth effect, one of the things is the Fed really believes this. And the funny thing is, there's a lot of studies that disprove this. The Fed believes that when the stock market is rising, when asset prices are rising, that the consumer will feel wealthier, will feel happier, and will go out and spend more money. So this is why the Fed is 100%, not 50%, not 60%, not 80 or 90, 100% ideologically committed to the wealth effect. Because they're Keynesians, because they believe in consumer spending driving an economy. They don't believe in production and in saving and then investing, which is key, to a long-term healthy economy, and is the free market in Austrian perspective that people should produce more than they consume, they should save the difference, and then they should invest it into a business or something else.
Sorry, go ahead.
Oh, yeah. So with the wealth effect, though, the Fed is 100% committed to this, and the Fed grasps at any data study that says the wealth effect works. So they'll ignore 100 studies that say it doesn't work, and they'll grab the one study that says it does.
Well, if you look at what the stock market's done, it's reached nominal all-time high. I give them credit. They've done a good job keeping the market popped up in nominal terms. If you look at what they did in the housing bubble, they created a big housing bubble, from 2000 to 2007, and now we have another small bubble being formed right now. So it's creating a little bit of wealth in nominal term in the housing market as well. So they've done a good job popping up those two markets. I'll give them credit for that.
Yes,
but in the long term, eventually it's going to run out of steam.
Exactly, and they've prevented, guys, the bond market from collapsing too. So they've gotten essentially the bond market to stay in a bull market. The bond market's been in the longest bull market of any of the asset classes. They've got the stock market back on nominal highs. They've reinflated the real estate bubble, and they managed to keep commodity prices down for the last basically 2 or 3 years. It's an impressive financial engineering job of intervention.
Yeah, I would definitely say it was. I'm shocked they could pull it off. I thought we had more free market forces than we do, but we just don't have many. And of course, they're going to come with a big bite. But it's unbelievable. Like, the bond market definitely would have collapsed. The only reason QE2 was done so quickly was the bond vigilantes were about to show up and say, hey, we don't trust you all to be physically solvent. Give us 6 to 7%. So they did QE2. And then they did Operation Twist. And I wrote an article saying that in December they're going to announce, December 2012, QE4, and I knew that because Operation Twist was ending in January 1st of 2013, and no one was going to buy those bonds. China doesn't want to buy them anymore. Japan, they really can't buy many of them. No one can buy them. And, of course, when they talk about an exit plan, you never hear the press saying, well, who's going to buy the U.S. debt treasuries if you all exit out of this?
Exactly, and because the U.S. is borrowing more and more money, it cannot deal with higher interest rates. I mean, a 1 or 2% move in rates. First of all, Japan's going to go first. You're going to see what's going to happen to Japan when the interest rates start to spike. It's not going to be pretty, and that's going to happen in the U.S. eventually, too. The U.S. is not as far along down the path to ruin as Japan, but because the U.S. is the world reserve currency right now and is being given more benefit of the doubt. But the U.S. is going to have an even worse collapse than probably Japan and Greece and all these other countries, because the U.S. is being given more rope to hang itself with. But Mo, you mentioned nominal returns. For our listeners out there, let's make sure we outline exactly what a nominal return is and a real return and how it works with the inflation rate. So if the stock market, Mo, has risen 10 or 15%, but the real inflation rate is 8 or 10%, are our listeners really getting a real return, or are they being basically double taxed then by the inflation tax, and then are they going to have to pay another tax to the U.S. government on capital gains?
Well, basically, nominal term is an unadjusted rate in exchange of value, so it doesn't include inflation. So when you talk about real return, you account for inflation. So in nominal terms, the stock market rises 10%, but in the real rate of inflation is 10%. You basically got nothing in return from the stock market.
Nothing but a big tax bill, right? Yeah, because you're going to have to pay capital gains on that 10% gain if you sell, right, and pull out. So the Fed then, this is a clever ploy then to actually confiscate even more wealth through the inflation tax and through a higher direct then.
Yeah, for them, this is a better alternative rather than doing what Cyprus is doing, which is withhold 10% of all of the people's deposit, which made everybody very angry. So, the Federal Reserve knew that they couldn't pull this off in this country because they knew it would be riots and outrage throughout the country.
And probably a bank run, too. Cyprus could trigger potential bank runs, right? Not just in the Cyprus or whatever as money leaves Cyprus. But, in the rest of Europe, I've heard possible bank runs now in Spain, Italy, and other places, too, worrying about this.
Well, Cyprus did shut down the banks from, Monday to Thursday. And I think the reason they did it was there was going to be a bank run. And they knew if they kept it open and kept talking about it, there would be a bank run. So I could see bank runs happening very soon. I think they will happen eventually. Personally, globally, I think they'll happen. And the other thing is the politicians like the inflation also because of capital gains tax. They have a lot of commodities taxed at the collectibles rate, like gold and silver. So there's the excise taxes. The governments get more revenue off inflation, not just through devaluing your currency, but then they devalue your currency against assets. You go to sell that asset, and then they collect more tax revenue and expands their power. So inflation is a government's best friend.
Yeah, and for listeners out there, there's some really good articles on this by Daniel Amerman. He has a free Turning Inflation into Wealth mini course. You can sign up for it on email. It's DANAMERMAN.com. That explains the difference between nominal and real returns and how, with the wealth effect, when the Fed prints money and raises the stock market 10%, but the real inflation rate's 10%, you're being taxed on the inflation rate, and then your total principal amount's being taken away with higher direct taxes, too. So, I really think any dip here, the Fed's I don't know exactly when the Fed's going to do this, but the Fed's going to expand its balance sheet again. Either it's going to be called QE or it's going to be called something else, and the Fed's going to expand its balance sheet again because the dollar looks like it's getting too strong.
Yes, and the Federal Reserve do not want the dollar to go up against the other currencies, so that's why we said in the past week or so that the Federal Reserve is going to have to do another QE program just to keep pace with what Japan and the British Central Bank is doing as well.
Okay, so let's wrap up then the Fed's exit strategy then. What would you guys say? There is no exit strategy, and the best the Fed is hoping for is controlled stagflation with managing commodity prices via, talking them down in Federal Open Market Committee minutes, saying we're not going to do any more QE or stimulus here or there, so commodity prices will take a break. And then, using financial repression and the wealth effect to manage asset prices higher?
Yes, and the ongoing currency war will continue throughout the country. You should expect more countries to participate in the currency war and devalue their own currency as well. So people should look out for that.
Yeah, I would say also, I definitely agree that I just think Bernanke said he's going to resign January 2014. I think this game could probably, based on that, Bernanke probably thinks he can play this game for a little while longer, and I think he might be able to. I'm relatively impressed, but I think the reason he's resigning is he knows it's game up soon, game over soon, or game set match or final buzzer, whatever.
Yeah, I agree with you, John, but I think, though, the U.S. is going to be saved for last where the bond vigilantes attack it, because there's just other countries in the near term in the G6 who have worse problems fundamentally, like Japan and British and stuff, and that could temporarily strengthen the dollar. I mean, if we have bank runs, right, in Spain and Italy and stuff like that, money's going to come here to the U.S. It's going to go into the U.S. stock market. It's going to go into U.S. Treasuries.
Oh, I'm just saying, I think what Bernanke thinks, that he can keep playing this game for one more year. I think it could go on for, maybe longer than that, because, there's a lot of problems. And if China has a housing bubble, China's looked at it the engine of growth, and if their housing bubble bursts, that would really put a temporary strengthen on the dollar. So that's one thing. That's one crisis that's not even being priced into a strength of the dollar. So I think they can play this game for a little while longer, which is fine for me because I'm trying to buy. I'm not trying to sell. So.
And that's great. So that's a wrap up for this podcast. And if people want to check out more of our podcast and articles, they can go to www.wallstreetformainstreet.com. They also can go to our YouTube channel. And we also have a Twitter and Facebook fan page for people to check out. All right, guys. Well, thank you for your time. And we'll check in hopefully soon again.
Thanks, and hopefully our listeners gained a lot of value from this podcast, and if they have more specific questions or they want us to help them with some research on dividend stocks, how to pick out good dividend stocks, the ones that are more undervalued than some of the larger cap ones, or how to find those really good resource stocks that we think over the next 2 or 3 years are going to make hundreds of % returns, they can contact us for some paid consulting.